Thank you very much for joining. This is going to be a fun panel. Just to do a quick intro, I'm the CEO of Into the Block. I guess most people know us as an analytics platform in the space. We have over 250 clients. But what not many people know about us is that the fastest growing area of the company is a division that works on quantitative strategies for institutions with DeFi. And we have over $1 billion deployed from some of the largest balance sheets in crypto. And Avalanche has been one of the greatest success stories. So we have a viewpoint about institutional adoption, and I have a great panel with me today. So please, John, do I have to introduce you? That's very stupid. Okay, so John Woo, that if you don't know who he is, he's the president of Avalanche, but if you don't know, just turn on Bloomberg any day, and they're gonna find you there. So John Woo from Avalanche, Aya from FalconX, and Ajit from Ava. So let's start with a quick round of intros. Aya, do you want to go first?
Sure.
I think you should skip John anyway.
We're going to wake everyone up here. I know it's 4:40. We are during the siesta, and it's institutional bag time. So super excited to be here. Thank you, Avalanche, of course, in this panel. My name's Aya. I lead institutional coverage at FalconX, so head of our sales trading division of the firm. We are a crypto prime brokerage. Prior to that, I was at Pantera Capital. And yeah, very excited for this.
And what is it with you and I on panels at conference? This is like the 12th panel we do. It's ridiculous.
So buckle up is all I can say.
But you're typically the moderator, so I get to annoy you for once.
Can't wait.
Okay, John, go ahead.
Hello. Hi, welcome everyone. I'm John Woo, president of Ava Labs, and I just want to say thank you for everyone here because it's this community that has made this event possible. And thank you for Jesus.
Nobody knows who you are, man.
Good guy.
Yeah.
Ajit Tripathi, I was with the Ava companies until a month ago. Now I work with the Ava DAO and with a few of my portfolio companies on incubating DeFi protocols, primarily focused on institutional adoption.
Yeah. All right, so we're going to talk about institutional adoption of crypto, but it seems that DeFi is the obvious place to start. And I'm going to start with John, with you. So as I mentioned before, Avalanche has been like a great success story for us. You guys have been incredibly clever about attracting DeFi protocols into to the Avalanche blockchain with very aggressive incentive programs. So we actually seen liquidity flowing from other blockchains into Avalanche. My question to you is, what happens when all those incentive programs end? Like, what is the future of DeFi for institutions, you know?
So the first foundational layer is actually not about the incentives. It's about having great technology and infrastructure built on top of the platform in order to allow developers have an easier time to develop things and attract users in a very easy way. So that is the first layer. Incentive programs only work when the technology works. And when we were comfortable with the platform and all the bridging as well as the user experience, trying to make it as close to a normal experience that even a Web 2 person would be able to use, that's when the incentive programs started. And you know, Ave was a big helpful participant in that. When these incentive programs end, it's going to be what Ava Labs does really, really well and continue to go forward with. It's creating innovation, attracting the most innovative products and applications and developers in the community on to continue to build great new things. So it's no different from other emerging technologies. That would be like saying, what happens to Amazon after, you know, free books are done? Like, what's next? It's more products, more technology, more innovation. But we are so far away from that right now.
Who is Amazon in that analogy? Anyhow, so joking. Ajit, you guys have been obviously extremely successful attracting institutional adoption. I think we have deployed several hundreds of millions in Ava across different blockchains. Are deals the killer application for institutional adoption in DeFi today?
I mean, so let's think about who is the institutional user, right? The marginal institutional user. It's primarily hedge funds and family offices. So what I've learned from the experience is that the permissionless protocol has far more institutional adoption than the permission protocol. So because the amount of friction that's involved in getting on board to a permissionless protocol, just connecting your MetaMask and using the protocol is a lot lower than getting into a custodial wallet and then connecting to Aave Arc. So Aave Arc has grown a bit slower, right? Because there is a certain amount of friction. You have to go through a bunch of internal approvals and stuff. But in terms of people who can use the permissionless protocol, they are just coming in every day. I mean, so institutional adoption, I think, I support John's view that, all the incentives are important and bootstrapping.
Let's not do that. Let's disagree. Don't support anybody. Let's disagree among them.
I would love to disagree, but
okay.
I think bootstrapping the ecosystem is important. But in the meantime, what we have to do is find the product market fit that doesn't depend on incentives, right? And that's as true for Ava Labs or Polygon or for Aave or anyone else. And what I'm saying is, the next generation of DeFi protocols is going to be far more interesting from a financial engineering standpoint.
Let's take a different point of view to your explanation about Aave Arc. So obviously you guys are pioneers on trying to introduce KYC AML at the protocol level, attract institutions that way. Aya, you have a very unique viewpoint sitting, I mean, you guys work with some of the biggest institutions in crypto. My question is this: introducing KYC AML at the protocol level seems like a non-trivial thing, like a trivial thing to do. Could it hurt innovation in the space?
Yeah, so I think, today the friction with UI UX and just overall onboarding is definitely keeping institutions back from applications like Ava Arc. So if you're not already onboarded with Fireblocks, you don't already know Aave and haven't looked at decentralized lending, then it's going to be a huge learning curve for you and incredibly painful. That said, it also depends on the market. In a market like this today, the rates that you'll get at a centralized lender aren't going to be substantially different than that of a decentralized lender because there's no demand for that. And so, in terms of the travel rule and innovation, I actually disagree. I think there's a lot of innovation that could go into figuring out identity in a really private way for institutions to feel comfortable with the liquidity on the other side. So for example, let's say you were able to KYC or there was an approval process on specific wallets. So there was a way to have a centralized KYC provider who approved different wallet addresses and said that smart contracts that engage with this wallet can be confirmed that we have their KYC documents and we're comfortable to share if needed, depending on the jurisdiction. So that's innovation that we just haven't seen today yet. I know there's a number of companies working on that, but that will enable DeFi. Now, the larger question though is why do institutions want access to DeFi? And really the answer to that is yield. Institutions just want access to 200% APY. Or they want access to a net new token that doesn't launch on centralized providers. And so you're seeing a lot of that interest now transform into private markets, and this is why you're seeing such high valuations on the private markets, because those players are trying to get access to the same deals or tokens in different ways. So I think the innovation is happening, but it's happening for different players and different personas, and also different types of institutions, like you mentioned. The type of innovation that you would need for a 50 billion plus asset manager is very, very different than the innovation that you would need for a family office or a hedge fund.
So Jesus, can I build upon both what
you're already hijacking the panel. We're 5 minutes into this.
So yields are high now because incentive programs are there, but they will always be higher in a DeFi-like permissionless ecosystem than in traditional CeFi instances. And the reason is very simple. You're taking intermediaries out of the system.
Of course.
And right now, there's two types of products out there effectively. You have DeFi products where you have higher return But effectively, you have a lot of risk and a lot more different type of risk, from technology to rug pulls to all that stuff that doesn't exist in traditional CeFi. So you get rewarded for that high risk by high return. In a centralized system, you've got a gazillion intermediaries. Most of them serve a good purpose for regulation or for whatever. Then you've got certain legacy institutions that are basically just extracting their Schumpeterian rights because they've been there, Schumpeterian rents, because they've been sitting there forever. Now, in this new world of permissionless DeFi, when regulation is clearer and you remove a lot of these intermediaries, you won't have all those guys taking pieces of that return out of the equation. So right now you have two worlds. You have high risk, high return for people willing to do that, and then you have lower return for more guaranteed money there. And once this system is more proliferated in all of finance, you're going to still have higher yields because you remove all those intermediaries, especially the one just squatting.
So I don't know if you did this on purpose, probably you did, but it's a brilliant segue to a couple of questions I have here about risk. So obviously this is an area...
Only because you asked brilliant questions.
Yeah, I forgot that you read the questions, but we spend a lot of time thinking and creating quantitative models to deal with risk in DeFi. One of the ways that we think about risk, I published an article in CoinDesk precisely about this point, is so the analogy that you were using, when you remove the intermediaries from traditional market, what you're doing effectively is pushing that risk to the infrastructure level. It's not that the risk dissipate, it's that you don't have a market maker that is absorbing the risk or a lender. It's at the infrastructure level. So Ajit, how do you guys think about risk at the protocol level beyond hacking? Like everybody knows that there is an intrinsic risk with something being hacked, or let's say an exogenous risk. But at the infrastructure level, how do you deal with, how do you think about liquidations? How do you think about that when we're talking about institutional adoption?
So see, the centralized system, TradFi, is very, very good at hiding risk, right? So we believe that there is higher risk in DeFi, but Evergrande, the wonderful Chinese property business, just went down yesterday. And for a while, there was no risk. For a long time, there was no risk in Lehman Brothers, right? And I unfortunately was on the team that essentially was trying to calculate our exposure to Lehman at Goldman when the whole thing went down. So there is a lot of risk in TradFi. Right? There's an extraordinary amount of risk in TradFi. It's just very well hidden. What we're trying to do with DeFi is, make it obvious as to where the sources of risk are, bring the data, make it transparent. You can actually see where the exposures are, right? Who has what exposure to who. So if Aave and Maker, for example, through the D3M module have some interrelated risk, then you can calculate it. It's out there. There are dashboards. You don't need to ask us for permission. You can build your own, we're not hiding anything. It's all out there. So the risks in CeFi are hidden for a long time. The perceived risk is lower. And maybe, BlockFi is delivering those yields by essentially hiring a bunch of traders to do the grayscale arb. Is it risk-free? I mean, really? So, so TradFi is good at hiding risk, and then one fine day it all blows up. In DeFi, the risks are visible.
Yeah, let me push you on this. You guys are getting away too easy here. So let's say that an intrinsic risk with Aave is liquidations, right? That happens. And with any lending protocol. Let's say that, is there a version for institutions in which Aave Arc builds something natively that mitigates that risk at a different level?
Yeah, so one of the reasons we built Arc, right? So we knew that the journey is going to be more challenging because there is going to be more friction. But it wasn't about yield. It's about getting institutions involved in the governance for DeFi. If you're going to scale DeFi to web scale, right? If you're going to go from 200 billion to, let's say, 20 trillion, then the only way that happens is if this new market infrastructure that DeFi is building, the internet-enabled Web3 market infrastructure, that is governed by institutions, right? So once institutions get involved in the governance of Aave or Aave Arc, then they can come up with improvements, right? They can come up with things that make sense for the institutional market. So the Aave companies, the devs don't have to build it. The institutions can come in and invent things that make sense for the institutional market. This is why decentralized finance is so powerful. You create what you need. So, you don't need to wait for 20 devs from Aave companies to do it. You come and build it yourself. And it's pretty, that open innovation, that permissionless innovation is the most powerful thing about DeFi.
So John, let me take a slightly different question. So I'm an Avalanche fanboy, so you know this. So one of the things that I like a lot about the design of the core architecture of Avalanche that I think play out in your favor was the segmentation on different blockchain, the C chain, the X chain, the P chain. Could Avalanche natively build capabilities to mitigate risk for institutions to adopt DeFi protocols on the platform?
It's a perfect segue into the Avalanche subnets now.
You see how I did that? Like that was smooth. Yeah.
Great questions from a very smart man.
Yeah.
So the Avalanche subnets is a great construct. Not only does it help, the state issue and capacity to increase and scale, but very important, we've already announced partnerships with many institutions and traditional, I say traditional, but DeFi crypto native applications that are going to be creating a subnet for institutional DeFi. And what you do now is you allow the governance to be at the network layer so that you can have two layers, the smart contract layer as well as on the network layer. That way you can even tier the level of security and the level of compliance. So there's different types of accredited investors to qualified investors, and then there's different regulations for banks versus others. So you can even create, we're working on something where you allow the user to basically identify what level tier they want to be in, and then the banks themselves or anyone else part of this institutional DeFi subnet can allow access to certain product securities based on that tiering of KYC, AML, accreditation, qualified, et cetera, et cetera.
So what could go wrong with that? Like, is there a scenario in which you don't see enough liquidity being attracted to that it becomes three hedge funds playing with each other, like things like that?
So can a consortium be built is basically, will it be too much of a scenario where, if you have one wrong lead or two wrong leads and no one else wants to join? So there's been a lot of precedents on this. If anyone goes and studies credit cards all back in the day, I think it was not Visa, but it was called Bank of America card. And they try to build the whole merchant network as well as bank networks. And they found ultimately in the 1970s, and most of you were not born back then except for Jesus, but back then they could not really grow that until they realized they had to shed the name and get everyone involved and have part ownership in the Visa network. And then that's when it really started taking off in the 90s and the 2000s.
What could go wrong with the multiverse institution subnet that John is trying to build?
You're facing me as the pessimist.
Yeah,
of the
let's.
group here, but, so the one thing we're not talking about here is capital efficiency. So the reason that all of liquidations work really well in DeFi is because they're highly over collateralized.
Yes.
So you have it over 120% collateral, whereas in traditional markets, it's highly under collateralized. And so like a lot of the gap that goes back to innovation is no one's necessarily thinking about credit scoring that can be shared across different wallets, different users, different providers, different layer ones, in a way to create capital efficiency. Because at the end of the day, if my dollar is going to go farther in traditional markets, there's absolutely no reason for me to go through the friction of onboarding onto some of these platforms. And that said, it's being worked on. The other piece is just as it pertains to flash crashes, but DeFi is actually proven to be incredibly strong across all of the last 2.5 years. All the flash crashes, DeFi performed much, much better than traditional markets. And what's so astounding here is that in traditional markets, when you have a mass liquidation event, the centralized exchanges shut off. So the NASDAQ will turn off, the S&P will shut down, and they will start to go back and audit their books. And so account for trades relative to orders that they've matched. And you don't have to have that in DeFi because the technology works so well. And I think that's really, really important to call out. In general, this is a very, very hard problem to solve. How do you solve risk that you're handing over to the user that you aren't inherently owning yourself, whether you're hiding it or not hiding it, but how do you hand that over to the user in a way that's capital efficient? And I think the larger question here is really around privacy. If you're trying to maintain that level of privacy, it may be much harder for you to do that.
Let's build on a point that you mentioned. So DeFi today, in terms of adoptions, is two things: is AMMs and lending. I mean, there are other capabilities, but those are the two main primitives in the space. So AMMs are cool, but they're incredibly inefficient in terms of capital for institutions. Lending in DeFi is cool, but it's extremely over-collateralized. So when you go to your clients on FalconX, big hedge funds and all that, and you have this gateway to DeFi, like how do you reconcile the simplicity, the transparency with the inefficiencies of the market?
Yeah, so today, because of the travel rule, none of our client assets can touch DeFi. And
yes.
so we're
that was the lawyer disclaimer.
Yeah, very important to clarify that. Very excited for a solution that can solve for that. But instead, what our clients will do is just purchase the underlying asset in a way to either go long or short the specific project and express their views in the market. That said, a lot of projects will launch their tokens directly on AMMs without needing to go to a centralized exchange. The reason for that, which is very exciting, is because launching on a centralized exchange is very expensive. You typically pay anywhere between $150,000 to $200,000 in upfront fees, and you have to have a market maker directly on day one. And so you see a lot of these projects go directly to AMMs and spend more of that money or resources on building a community to launch with that token on day one, which is tremendous. So a lot of centralized players can't access those markets necessarily on day one and have to wait for that liquidity to then move to centralized providers, exchanges, OTC desks, dark pools, or natural buyers and sellers. Same thing with lending. What's very fascinating on the lending side is that you can get a loan for 2 days and 5 hours. And so the flexibility that you get in decentralized finance is far, far greater and much better for the use cases that you're servicing. But that said, you pay for that flexibility with over-collateralization. And also just in terms of supply, there's greater supply for a lot of these tokens in decentralized finance as opposed to centralized. You have to go and really hunt for some of these tokens and supply for those tokens as well. So it's, there's two sides to the coin.
Yeah. Ajit, do you want to build on that? Like, how do you solve for the inefficiencies of DeFi for institutions, particularly in lending and AMMs?
So I think, I don't want to be too philosophical, but I'll say that we're not creating this infrastructure for Wall Street, right? As in, the role of Wall Street is twofold. One is to bring liquidity, and the other is to bring, distribution. So the reason we built Ava is because, we weren't getting quickly enough to 8 billion people, right? And so we realized that intermediaries are required for distribution. But the goal isn't to get just money from Wall Street, right? That's not why we are doing this. So the question is, yes, once you bring in institutional liquidity, sure, there is a need for capital efficiency. Yes, for that you need some level of identity, reputation, and recourse so that you can reduce the collateralization. But if we drop decentralized governance and open permissionless innovation, then we should all pack up and go home, right? So let's think of this in terms of priorities. This isn't about institutions have a role, and that's to create distribution. Now, how do we do that, right? So you need an identity layer, you need a reputation layer, like credit rating. So you have to build the whole infrastructure if you want to bring in the same level of capital efficiency as TradFi. But that isn't the point at all. The point is to create new infrastructure, web scale, online, always on, resilient, transparent, open, permissionless, innovation-based infrastructure. Those are the goals. Now, if you want to bring all the talent from TradFi, right? All of the financial engineering people like Aya and John, all the amazing talent. Then we have to create all this software and make it easy for people who are looking over their shoulder, their compliance officers, and get them into DeFi. That's what this is about. This isn't about just getting a few $1 billion from institutions.
So you mentioned governance twice. So governance, DeFi governance is not very decentralized today. And as a matter of fact, there is all sorts of market manipulations that happen with that. Like we see it, right? People influencing different votes and things like that. how do you foresee the role of large institutions in DeFi governance? What should they be doing? And even more interesting, do we need better governance models at this one token, one vote type of thing that we have today?
Yeah, so the second question is easy to answer, right? Absolutely. We need better systems than one token, one vote. In fact, quadratic voting and other experiments are already being done, right? Or NFT-based governance. There are many, many models people are experimenting with. The power of DeFi is that it's evolutionary. As in, if we stop the crazy, sometimes really stupid type of experimentation, right? If we stop making mistakes in DeFi, then that's the worst thing we can do. So the innovation is happening because these 23, 24-year-olds who have no idea how TradFi works are actually inventing amazing things that half the time make no sense, right? But that's why we are inventing and moving so fast. So we need to make more mistakes, not less. Now, how do we create a safe environment for making mistakes? That's the challenge for DeFi, and it's not to reduce the amount of mistakes we're making, is to be more creative, to invent new protocols, to create structured products, to do more financial engineering. Examples are like Squeeze, right? It's very, very hard to make options work on-chain.
Yes,
but they modified the structure to create a different structured products. Ribbon is a great example. There are lots of cool things that are coming online. We just want more experimentation and more innovation. Now, if bringing institutions reduces the amount of experimentation, I don't want them.
I feel that you're killing my interview flow here because every time I have a question, you just jump to something else. John, let's build on that. How do you see your big institutional clients participating in DAO governance, in DeFi governance?
The next question first, or answer
no,
this
no,
and then
I moved the question to you because he keeps hijacking the...
Well, I think institutions actually, you hear Jamie Dimon constantly complain about these fintech companies that do things that he is not allowed to do because he's regulated differently as a bank. So a lot of the stuff that we are doing in DeFi, they're kind of trying to do it in fintech as well. You know, you have Affirm, you have Afterpay with, you know, pay now, you know, bill me later, whatever kind of concepts after, buy now, pay later kind of concepts. And they're using better AI to better score, and then now they're not scoring your credit scores on the individual, but on the transaction level. So maybe you're a person that shouldn't be buying a house, but you can buy a car, or you can buy a candy bar, whatever. That disintermediation of the banks and the institutions is happening on existing infrastructure, existing rails. What DeFi is doing is going to disintermediate the fintech people as well as the banks, because we're building it from scratch. So if I were the institutions, I would be doing what some of them are doing, which is partnering with Avalanche and Ava Labs and creating subnets for their own use cases.
So let me move to a topic just orthogonal to DeFi, but not DeFi. But so one of the things that Avalanche does really well, that is bridging, right? So you guys sort of created a good experience for this, but it's still a major pain to move assets between blockchains for Avalanche and for any other runtime out there. How do you guys think about bridges, and what has to happen for people to not think about bridges anymore and make it completely transparent?
So Ava Labs is very good at bridging in two ways. One, I think you're referring to the technology sense. The Avalanche bridge from Ethereum is one of the best experiences, fastest and lowest costs out there. Billions and billions have been moved from Ethereum to Avalanche and back and forth. The second thing Ava Labs is very good at bridging is people and mindset. If you look at this crowd here, it is far more diverse in terms of traditional finance people to crypto native degens, as they call it. Everyone in between, they're all here. So Ava Labs is very good at bridging in figurative as well as the technological sense. Now, to answer your question, the dream really is 5 to 10 years from now, you're not thinking about bridging in the multi-chain world. It just exists. It's like you don't think about AWS anymore. You just put it up there.
So, Aya, do you think about the bridge, like if you need to predict this, do you think in 2-3 years, do we have 1 or 2 bridges in the market, or do we have like 20 like today?
Yeah, so a couple points on the previous conversation too. that I think...
You said I keep doing that.
I know, we're just going to throw a wrench in here. But it's really important to just define what institutions are and who you're building for. There are more DAO tools than DAOs today, as an example. And, if you're thinking about who are they actually servicing, again, each of the institutions' needs are going to vary tremendously. To the point on bridges, it goes back to the point around friction, right? Which is, there's so much friction today to get access to these different platforms. And the larger question is, how much yield is enough yield for an institution that differs from traditional finance, that's greater than 2% a year, for them to make their LPs happy, or for a retirement fund to actually make enough that's higher than a 7% inflation rate. And so that's really the question an institution is trying to solve. And it's not DeFi yield farming 24/7 in order to make over 20% yearly. And so with cross bridges, as we head towards a interoperable future, I think the solution is going to be exactly that. You're going to see multi-chains. It's likely going to be more than 2 to 3, but you won't see it in the same way that you don't see our cloud service providers. And in the same way, you don't see, in crypto, we haven't disassociated yet from the infrastructure layer. You're still actively engaging with it every day, and it's incredibly fragmented, even as a retail user, let alone as an institutional user. So, being able to move from that fragmentation to that next layer of actual just engaging with applications that are cross-functional, excited for that to happen.
Do you want to answer this question or the previous question too?
I want to answer the previous question. So one thing we haven't talked about is what it means to be an institution, right? I used to work in
you're serious about the previous question.
I used to work in enterprise blockchain. And we used to do all these private permission blockchains, VTrade, Congo, a number of consortia. Then I finally figured it out that that's the wrong way to go. So the way to do this is not to build enterprise blockchain. The way to build this is to build